Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. I see we've got some questions that have already been chatted up. Thank you so much for bringing the questions. We'll turn to those here momentarily. First, as always, the presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor is a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. We'd also like you to please like this video as it helps us to get the word out to others like you, other solopreneurs, other advisors who may need this information, who may value this information, who may be trying to secure their retirement. So if you could please like this video, whether you're on LinkedIn, YouTube, X, or Instagram, we would greatly appreciate it. All right, so again, we're here today at our daily Solo 401k webinar. We had one earlier. This is our second session, a Q&A session with my Solo 401k Financial, where we help you to stop overpaying taxes and start building real retirement wealth. We're going to start out with the questions, but just to preview the topic, married solopreneurs, how to still get $140,000 into mega backdoor Roth solo 401k for 2025. So this is your chance to get answers. Please use the chat now to ask questions on today's topic or anything else. We're going to first start out with Jeff. Thanks for bringing the questions, Jeff. I'm opening up my 3 brokerage accounts at Interactive Brokers. On the first page, about you, I've listed the trust as the account holder. Since there will be 3 accounts, should I add an identifier like trust name, Roth, or should I create a nickname later? Either is acceptable. I've also used the trust EIN in the about you, which is specific to the account holder, not the trustee. Is this correct? Well, they're going to need both pieces of information. So I would use the guide that we provided. They may have changed the format a bit, but the substance still applies. As the financial institution, of course, they're going to have to know their customer. And since ultimately the account is for your benefit, they will need your Social Security number. But you also want to provide them the employer identification number for the plan, which would be used to open up the account under the name and EIN number of the plan. Hopefully that makes sense, Jeff. Thank you for bringing the questions. We've got more from Jeff. Under beneficiaries, should I include myself, the trustee, or should the beneficiaries match the beneficiaries shown in the trust documents? So please list yourself as the beneficial owner. The beneficiaries of the solo 401k, in the event that the solo 401k owner passes away, that's governed by the beneficiary election form that we provide as the plan provider as part of the establishment process. So it's not the beneficiary election form that the financial institution themselves might be providing. So I would list yourself there. Good questions, Jeff. At the end of the application, under confirm your tax residency, it looks like they've added a couple of options. The designation they are using for federal tax classification is qualified retirement plan, not trust estate, as shown in the PowerPoint guide. Is this correct? Yes, that would be a correct answer. Oh, okay. Well, there you go. It sounds like they might have updated their process, probably just because of the volume of accounts that are being opened up over there at Interactive Brokers to actually specifically call out a retirement plan as an account type. Hopefully that helps, Jeff. Thank you for bringing the questions. Thank you so much for your business. Appreciate your participation. Please don't hesitate to chat over more questions. Next question is from Raul. Please correct me if I'm wrong, but I believe with Secure Act 2.0 for 2025, can we make both employer and after-tax contributions via an appropriate mega backdoor Roth strategy, but we were unable to make employee contributions if we established the 401k plan in 2026, January 2026. So it depends, Raul. So now it looks like in your case, the business is an S Corp. So in that case, you would be correct. It's if the plan is being established in 2026, it's too late if the business is taxed as an S Corp to make employee contributions. But if the business is taxed as a sole proprietorship, it's still possible to set up a solo 401k for a sole proprietorship in 2026 and make employee contributions for 2025, provided that those employee contributions are made by April 15th. even if the self-employed business tax return, in other words, the 1040, a timely extension is filed, that would only extend the ability to make employer and voluntary after-tax contributions for 2025. Now, in the case of a business tax as an S Corp, if the plan is being established here in January 2026, you could still make employer and or voluntary after-tax contributions for 2025 by the 2025 business tax return deadline, including any timely filed extension, but it would be too late to make employee contributions for 2025. Thank you for bringing those questions, Raul. Our next set of questions, our next good question here is from Rick. Does Fidelity offer in-service rollovers of pre-tax funds to another retirement account at another institution? So, first of all, we are the 401k provider. Now, customers will use our plan to open up accounts at the bank or brokerage of choice, such as Fidelity. But what you can do with the Solo 401k plan, whether that's in-service distributions or the type of investments or the ability to take a loan or the mega backdoor Roth, etc., depends on our plan documents, not what Fidelity's documents provide, because the individual is establishing the plan, meaning the documents with us, then using those documents to open up accounts at the bank or brokerage of choice, including Fidelity. Now, our plan documents are drafted to be as flexible as possible under the rules. But under those rules that apply to all 401k plans, if one is processing an in-service transfer out of the plan to another retirement account, you need to meet a triggering event or an exception. So if it's pre-tax funds in the Solo 401k, which were rolled over from another retirement account, let's say someone set up a Solo 401k and then funded it, at least in part, by rolling over money from a former employer plan. Well, funds that were rolled into the plan can be rolled out at any time without needing to meet a triggering event. So those would fall into the exception bucket. But let's say it was a pre-tax contribution to the Solo 401k. So it's not a rollover, but a contribution. So in that case, you can't transfer those pre-tax funds until you meet a triggering event, such as being age 59 and a half or older. But if you do, our plan documents would allow for in-service transfer out of those funds to another retirement account, whether it's an IRA or another employer plan, provided that the employer plan will accept the rollover from the Solo 401k. Great question, Rick. All right, next question is back to Raul. For an S Corp, must there be a minimum amount left in W-2 income after we complete the mega backdoor Roth contributions? No, there doesn't need to be a minimum amount. So one can contribute 100% of their W-2 wages as Solo 401k contributions, subject to the contribution limits. So if there's an exact match and their wages exactly equal the limits, subject to the contribution rules, et cetera, they could contribute, the individual will be able to contribute all their W-2 wages. There doesn't need to be any left over. Good question, Raul. Next question is from Kantaya. Thank you for the question. I would like to know how to connect you to my Charles Schwab account to take a loan for my Solo 401k. Great question. I gather that you already have a basic Solo 401k plan, an individual 401k plan established at Schwab, and now you want to upgrade the plan to be able to take a loan. And that's a common scenario. That's a common use case where someone already has a basic Solo 401k plan and now they want more advanced features or more advanced Solo 401k support. More advanced features would include, for example, the mega backdoor Roth, the $1,500 in tax credits, and of course, the ability to take a 401k loan. So that process is referred to as a restatement. So in that case, the existing plan will continue, but the plan documents will be restated to our plan documents, which do allow for being able to take a 401k participant loan. So new accounts would need to be established for the restated plan, but those new accounts can be at Schwab. So even though Schwab offers their own basic plan that doesn't allow for Solo 401k loans, Schwab will also open up accounts for people that bring their own plan documents. So the plan documents can be restated to our plan. Accounts can be opened up at Schwab. The cash and assets transferred over from the pre-existing account over to the new account that's governed by our plan document. And once the funds clear into the new accounts at Schwab that are governed by our plan documents, you can take a loan right away. Now, it's noteworthy that we're very hands-on throughout that whole process. For example, preparing the paperwork to open up the new accounts at Schwab for the restated plan, preparing the paperwork to initiate the transfer from the pre-existing account over to the new account, preparing the paperwork to document the loan. And all of that is included for no additional charge. Thank you so much for the good question. Next question is from RM. With Secure 2.0, believe it is now possible to make 2025, 2026 Roth 401k employer and Roth 401k employee contributions followed by mega backdoor Roth contributions. For an S Corp, how would contributions differ if both the employee and employer contributions were Roth 401k as opposed to pre-tax? I believe that the Roth 401k employer portion will not be taxed by FICA, etc., by payroll taxes. Would that make any difference from a tax perspective? So great question. So you are correct. And our plan documents would allow for all of those Roth types of contributions. Now, from a practical perspective, based on experience and client feedback, for those that are looking to maximize dollars going into their Roth solo 401k, many will just keep it simple. They'll just skip employee, skip employer, and then just contribute 100% dollar for dollar of their self-employment compensation. For example, W-2 wages from the S Corp as a mega backdoor Roth contribution. So for example, for 2025, as long as they have at least $70,000 of W-2 wages from their S Corp, they can contribute $70,000 as an after tax and then just not make any other contributions to the solo 401k and then transfer those funds over to a Roth solo 401k. Now, if you do make a Roth 401k employer contribution per IRS guidance, that's going to be more complicated from a tax reporting perspective. So that's part of the reason I would say why individuals will oftentimes just choose to skip it. In addition, you need higher self-employment income to justify the same amount of contributions, because unlike a voluntary after-tax contribution, which you can contribute 100% of your wages, employer contributions are limited to 25% of the wages. So you can only contribute 1/4 or 25%. But let's assume you decided to make a Roth employer contribution. It would be deposited into the same Roth account. So between Roth employer and Roth employee contributions, they both get deposited into the same Roth account, the same Roth account that you would transfer your voluntary after-tax solo 401k funds to. So from a transfer perspective, it would go to the same Roth account. Now, from a reporting perspective, when you make a Roth employer contribution per the IRS guidance, it still needs to be reported as tax deductible on the employer's return for the year for which the contribution was deposited, but then be taxable to the employee it's deductible for the year for which the contribution was made. Let's assume that it was made for 2025, but in 2026. So it would reduce the employer's taxable income on the employer's return. So it's tax deductible on the 2025 employer tax return, in this case, the 1120S. But let's say it was deposited in 2026. In that case, it would be taxable to the employee in 2026 for the year of the deposit. So it's tax deductible on the employer's return for the year for which the contribution was made, but taxable to the employee for the year for which it was deposited. It would be taxable via 1099-R. So it would look just like as if you had made a pre-tax employer contribution, but then immediately converted the funds to a Roth solo 401k. Now, as far as the FICA considerations, one needs to have W-2 wages to justify all contributions. And when you make solo 401k contributions, regardless of the type, whether it's employee, employer, or voluntary after tax, it doesn't reduce your obligation to pay those payroll taxes. So that's number one. Number two, you don't have to make the contributions through payrolls. You don't have to gross up your W-2 wages to be able to make those contributions. It's certainly acceptable from a solo 401k perspective for the contributions not to be made through payroll. Now, if you choose to make a Roth employer contribution, that could be made from the business account. That could be an additional transfer out of the business account. Like, let's assume that $100,000 of W-2 wages was paid to the individual. So that's a tax deductible expense from a business perspective, because the business is paying you $100,000 of W-2 wages. And then on top of that, if the business were to make a $25,000 employer contribution, that would be an additional deductible expense, even if it's made as a Roth contribution, as it just explained up above. So the only part that's considered to be subject to the payroll taxes are the wages. That additional employer contribution, it's not subject to payroll deductions. Hopefully that makes sense. More from RM. Thank you for the continued questions. For an S Corp, can business dividends profit sharing be used? So it's not business dividends, it's referred to as a profit sharing contributions to top off the after-tax bucket, or is it only from remaining W-2 income? You have to have the W-2 wages to justify the contributions. So if your W-2 wages are $50,000, the total amount of contributions that can be contributed to the solo 401k between employee, employer, and voluntary after-tax cannot exceed $50,000. The whole point of a 401k is for people who work to be able to save for retirement. So a solo 401k is for self-employed people to be able to save earned income. So you still have to have that earned income to justify the contribution. You can't use K1 income that you receive as the owner of the S Corp to justify those contributions. If Fidelity, back to Rick, if Fidelity doesn't offer, do you have the ability to roll over part or all to a different account? Again, it's not dictated by Fidelity. It's dictated by our plan documents, which follow the rules. So if you meet a triggering event, such as being age 59 and a half, or the funds that you want to transfer out fall into one of the exceptions where those triggering events don't apply, such as rollover contributions or voluntary after-tax contributions, those can be rolled out at any time without needing to meet a triggering event. And our plan documents allow it. So Fidelity doesn't dictate. Thank you for the good questions, Rick. Next is Ankit. I'm new to this. My wife and I both have rollover IRAs with Merrill. We want to roll over that from the IRA to the solo 401k with checkbook control. So if you're both self-employed with non-owner, non-spouse, full-time W-2 employees, including reporting earned self-employment income and your taxes, you both could set up a solo 401k and then be able to transfer funds from a pre-tax IRA to your respective pre-tax solo 401k accounts. We also want to open a traditional 401k and a Roth IRA or the mega backdoor Roth. Can I work with your company to help me create these at Merrill Edge? Most certainly, Ankit. We definitely have had many, many customers who get the documents from us, and then we help them open up accounts at the bank or brokerage of choice, including Merrill Edge. So this is the new plan that rolled out. Does the 59-year-old matter? So if it was rollover contributions from a pre-existing retirement account to the solo 401k, then you don't have to meet a triggering event. You can roll money out that you rolled in at any time. Back to Kantaya. I've not opened an account with Schwab yet, needing to do a direct rollover for my employer that I've separated from. I see. So if you are self-employed with no non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any. So self-employed is demonstrated by reporting earned self-employment income in your taxes, such as on Schedule C, if your business is taxed as a sole proprietorship, or W-2 wages, if your business is taxed, for example, as an S Corp, then you would be eligible to set up a solo 401k, and you can most certainly roll over funds from a former employer plan. And once the funds hit that account that's established, which could be at Schwab, because again, we help customers open up accounts at the bank or brokerage of choice, including Schwab, then you'll be able to take a loan because that Schwab account is governed by our solo 401k plan documents, which do allow you to take a loan. Then you would submit a questionnaire on our website to prompt us to prepare the paperwork to document that loan. So when you take a loan, and it's not going to be subject to taxes or penalties, as long as it's documented as a loan, as long as it's within the loan terms, as long as it's paid back according to those loan terms. So those loan terms are going to require that the loan is limited to no more than 50% of the balance, not to exceed $50,000. It needs to be paid back in monthly or quarterly payments, up to you, equal payments of principal and interest. the interest is prime plus 1% or a CD rate plus 2%, with those payments spread over a 5-year term. And again, we prepare the loan documents for no additional charge. Customers just have to submit a form on our website that prompts us to do that. For Form 5500EZ, do after-tax funds rolled over to a Roth IRA count towards the $250,000 amount? No, they do not, as long as they're not in the solo 401k as of December 31st, because that's the key date in terms of whether that 5500EZ threshold has been met. Thank you, WA, for the good question. Can employee Roth 401k be rolled into a Roth IRA for an S Corp after the mega backdoor Roth? Only if you meet a triggering event. So that's another reason. Remember, I stated that a lot of folks will keep it simple. They'll skip the employee, they'll skip the employer. They'll just make a pure voluntary after-tax contribution. So when you make a voluntary after-tax contribution, it first is deposited into a separate voluntary after-tax account, and then the solo 401k owner has choices. They can transfer the voluntary after-tax solo 401k funds to a Roth solo 401k, keep it in the plan, or they could decide to transfer it out of the plan to a Roth IRA, including in a pre-existing Roth IRA that they already have. In either case, that's going to be reportable. It's going to be reportable on a Form 1099-R, which we handle for no additional charge. Customers that are advisors just have to let us know when there has been a 1099-R reportable event, such as a transfer from the voluntary after-tax solo 401k account to a Roth solo 401k or a Roth IRA. They can do it quickly and easily on our website, mysolo401k.net/forms, to provide us the information so the plan can be added to the queue for that 1099-R to be prepared. Okay, that's a great set of questions. Again, if this is helping you feel more secure about your retirement, please like this video, as it helps others like you, whether you're advisors or solopreneurs who might need this information to secure their retirement. Find it. So please like this video, whether you're on LinkedIn, YouTube, X, Instagram, etc. All right, let's talk about the $140,000 opportunity. Because again, we want to talk about a scenario where you have married solopreneurs. Let's say they're two realtors that are both working in the business together. No employees. They'd be eligible to set up a solo 401k. Well, there's a $140,000 opportunity. And let's break that down, how they could potentially get $140,000 into a mega backdoor Roth for 2025, even if they haven't set up a plan yet here in 2026. So let's first start out with the limit. 2025 IRS overall limit is $70,000 per person. So if you have two spouses that are both working in the same solo self-employed business, both participating in the same solo 401k plan, each spouse, as long as they have at least $70,000 of self-employment income, each spouse is going to be able to contribute $70,000 as a voluntary after-tax solo 401k plan, voluntary after-tax solo 401k contribution to the plan, to their respective accounts in the plan. So if the husband has $70,000 of W-2 wages, let's assume from the S corporation, the wife has $70,000 of W-2 wages from the same S corporation, they could each contribute $70,000 to their respective voluntary after-tax accounts and then transfer those voluntary after-tax solo 401k funds either to a Roth solo 401k or a Roth IRA, where it's going to be just like any other money in a Roth account. It's going to have that tax-free growth potential, tax-free retirement withdrawal potential. In other words, ultimately, when they withdraw the funds from the Roth account, if they're able to withdraw it as a qualified Roth distribution, let's assume they've had the Roth account for at least 5 years, then they're at least 59 and a half years of age, they can take the funds out of that Roth account, that Roth solo 401k account, totally tax-free. What if I didn't set up the plan by the end of December 2025? No worries. The plan can be open in 2026, regardless of how your self-employed business is taxed, because we're talking about making voluntary after-tax solo 401k contributions. That's how you make that $70,000 mega backdoor Roth contribution for each spouse. So for a total of $140,000. So a plan can be established with my solo 401k in 2026, which is going to automatically include the ability to make those voluntary after-tax contributions for 2025 by the 2025 business tax return deadline including any timely filed extension. So regardless of how their business is taxed, whether it's taxed as an S Corp or a sole prop or a C Corp or a partnership, they can fund those 2025 voluntary after-tax contributions in 2026 by their business tax return deadline, including any timely filed extension. Now, again, the eligibility, how you get into the game is you need to be self-employed, an owner-only business specifically. So in other words, no non-owner, non-spouse, full-time W-2 employees. Both spouses would need to work in the business and report their own earned self-employment income. Now, both spouses wouldn't need to be owners of the business, but both spouses would need to work in the business and report their own earned self-employment income. So they could skip, each spouse could skip the employee. And again, if they didn't set up a plan until 2026, they may not be able to make employee contributions for 2025. They could only make employee contributions for 2025 if the business is taxed as a sole proprietorship. But it's no big deal because with this $140,000 mega backdoor Roth strategy, you're not relying on making employee contributions. So they can just be skipped. You could skip employer. You could just make 100% of your self-employment compensation as a voluntary after-tax contribution up to the overall limit, which is $70,000 per person, per participant. Now, it's going to make sense to act sooner rather than later, right? There's still time, but most will want to go ahead and get started sooner rather than later so they can take their time to open the accounts, make the contributions, determine how much they're going to contribute, determine how much they're able to contribute, and then deposit those funds into their respective voluntary after-tax accounts. Now, there is no deadline to convert. The only deadline is to set up the plan in time to be able to make those 2025 contributions by their business tax return deadline, including any timely filed extension. There is no deadline, though, to do the second step of the mega backdoor Roth solo 401k strategy, which is to get the funds into a Roth account. So the first step is deposit into the after-tax account. That's where the deadline comes in. And you need to go to that after-tax account so you can take advantage of those higher voluntary after-tax contribution limits. Again, 100% of the compensation all the way up to the overall limit, which is $70,000 for 2025. That's assuming that no other contributions were being made to the solo 401k. So that's a 10x contribution limit as opposed to a Roth IRA, potentially 10 times what could go into a Roth IRA and multiple times what could go into a Roth solo 401k. So you want to get into that after-tax account so you can take advantage of those much higher, relatively speaking, contribution limits. But that's not all. You then want to move the money from the after-tax account to a Roth account. So now it's going to be treated just like any other money in a Roth account where you've got that potential for tax-free growth. The critical deadlines are the business tax return deadline. So for an S Corp and a partnership, that's March 16th, 2026 or September 15th, 2026, if a timely extension is filed for the business tax return. For a C Corp and a sole prop, it's April 15th, 2026 or October 15th of 2026 if a timely extension is filed for the business tax return, which would be the 1040 in the case of a sole prop. Again, sign up early to allow time for plan documents and account setup. Now, we're very fast with the plan documents. We prepare those within the same business day when clients sign up. Now, we've talked about the advantage here is the ability to make a mega backdoor Roth contributions, but the potential, if it's a married couple, of $140,000 going into a mega backdoor Roth for 2025. But that's not all, right? There's other advantages of working with my solo 401k financial. Other ways, for example, to get money into a Roth account. For example, Roth conversions, employer Roth, of course, employee Roth, the ability to claim tax credits. We're the first provider to offer a solo 401k plan that supported the mega backdoor Roth. We're the first provider to offer a solo 401k plan that supports the $1,500 in tax credits. So setting up our plan will make the self-employed business eligible to claim tax credits of $500 per year for 3 consecutive years. That's a total of $1,500, which will more than cover our fees for the first 7 years. We charge $650, which includes the $525 establishment fee, plus the first $125 annual fee. Then starting 12 months later, we charge our $125 annual fee that covers the second year. And that's a totally flat fee, regardless of the service and the solo 401k services and support needed, regardless of the value of the account. Now, some of that support is going to include, for example, the 5500 EZ if needed, which we do that for no additional charge. the 1099-R, which would be needed if you're making a mega backdoor Roth solo 401k contribution, the ability to invest in alternative investments, true alternative investments like real estate, crypto, private placements, pre-IPO stock, etc. The ability to take a 401k participant loan, where we do prepare those loan documents for no additional charge. And that's a key requirement if you're going to take a 401k participant loan. So ultimately, next steps to get started would be to go to our website, mysolo401k.net, click on open account, then click on get started under solo 401k. It's just a quick 1-minute application. That's how we capture the information that we would need about you, about your business, to be able to prepare the plan documents. Once the application is submitted and payment is made, we prepare those plan documents within the same business day. So we act very quickly so you can get going as far as opening up the accounts and making the contributions. All right, more questions from RM. Thank you so much. Does the $250,000 5,500 easy threshold also count employee or an employer? Well, it's just based on the value of your solo 401k. So the cash, the investments, etc. as of December 31st. You also need to factor in the value of any defined benefit plan that might be sponsored by the self-employed business. So it's just based on the value as of the end of the year. Great question, RM. Thank you. Thank you, WA. So for example, if $50,000 of after taxes deposited to the after-tax solo 401k bank account on December 31st, 2025, and rolled over to a Vanguard Roth IRA on January 20th, 2026, that $50,000, if it caused all the solo 401k bank accounts to go over $250,000 for one day, means the 5,500 EZ would need to be filed. Yes, it would need to be filed by July 31st, 2026. That is correct, WA. So yes, please like this video. Helps us to get the word out there. Please subscribe. We do go live every day. We were live earlier today. This is our second session. Subscribing guarantees you get notifications of all of our crucial content that we deliver every day to help you secure your retirement. Well, it looks like that's it for today's Solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this Solo 401k community. We'll be back here tomorrow with more crucial content to help you secure your retirement.